Okay. So a lot of things have been happening in the mortgage industry, and I've been reading about it. Joe's been sending me information, and I've been talking to people who are first-time buyers, and they're wanting to get in on some of these programs. And Joe just sent me some disturbing news about one of the
Yeah.
programs I was totally excited about, but I knew that would happen. And so let me just give it over to Joe right away, if that's okay, because
Sure.
he does have some exciting things to share. And I do want him to share about some of the programs that are available to us as realtors. And we need to make sure that we stay in direct communication with Joe for all of our loan scenarios. Anytime something coming up, just make sure you get in touch with Joe first. And it's up to us as realtors to be familiar with programs, but it's absolutely Joe's job to know. And he's the expert. And I always like to make sure people understand that he's the expert when it comes to getting loans. So with that, Joe, it's all yours.
I appreciate that. Catherine and Jacqueline, Marlene, it's been a while. I hope the new year's going great for you all. I today want to go over what has been going on this year in the market. Just a real brief recap. It's going to be really abbreviated because there has just been a ton of stuff in the MBS industry. I did want to let you all know that I am back at Catalyst Mortgage. I know that Marlene and I had talked about this. It doesn't change anything really for what we're all able to do. It was just a move that I had to do on my own because of the way the industry was going. Catalyst had a little bit better opportunity, but Guild is still a fantastic company, and I hope to join back that team again in the future. But wanted to let you all know that I am over at Catalyst to still have the opportunity to do the programs. Here's the other great thing, Marlene, I didn't think I touched on this. With going back to Catalyst, that opened up 16 states that I can operate in, including Tennessee. In fact, I am on my third loan, Tennessee loan.
Awesome.
So that'd be great news once Monique, if Monique were to need the services or starts her company, her realty taking off over there. I know that she's
Yeah.
getting ready to get that set up. So let's start off with a little bit about what happened this year so far with the industry and the rates and whatnot. We were continuing to struggle in the beginning of the year. Rates were still, and the bonds were still super high as far as coming off of the November gains. Right about the 1st of February, we hit a big crash. Rates got to the lowest levels that they've been since, what is this, October? Geez. Yeah, November 3rd. And actually November 3rd was the lowest these rates have been, or highest, excuse me. A number of things had been playing in the buildup, meaning that October, November, December, those items that were pressuring the market were pretty standard items. The inflation results, the CPI, which is the Consumer Product Index, which is an index that shows consumer products purchasing. This is a true inflationary index that talks about what you and we're buying and able to buy, and then on the transverse is not able to buy. It tracks those type of purchases, including gas and food. There's a core PE and there's PE. So those reports came out positive in November. Get into January, we have numbers that are coming out of December because it's all reverse looking. And so January rates were fantastic because we had all of the Christmas employment and all of the Christmas shopping and the numbers, and really inflated information. January numbers are always kind of inflated. But in our market, ladies, it is very true that in the mortgage-backed securities and treasury market, it can be contagious and it can be reactionary. And if somebody gets a little nervous, big corporations get a little nervous, some bad news comes out, then the rates move and the industry moves quickly. Hence what happened starting in, really the 1st of March, right about, we started hearing about this March 3rd. So rates were increasing all through February. We had the jobs report that came out in January. Of course, in February, came crashing back down. The report I'm referring to is the increase of employment year over year. And in January, we showed a 500,000 job increase. Again, this was a skewed number. Everybody knew it. The reaction of the market didn't care. They loved that number. Remember, anytime there's good news in the economy, it's bad news for us. And unfortunately, that's the role we play in. Nobody wants to hope for bad news. And we really want to get to a balance. But right now, in the volatility, bad news is good news. And so February came back around and jobs reports came out 130,000 below expectations. So we went from over 500,000 jobs incorporated to less than 130 in 1 month. Again, this data seems dramatic, but the honest truth is we've been averaging in those hundreds. And so it really should have been, the reaction should not have been that strong in January. Come February, we had the actual numbers come in. And then I don't know, some of you are out in the area. Then come along March, and we had the Silicon Valley Bank collapse. And so the reason why this is important, I wanted to bring this up, is the Silicon Valley Bank collapse was great news for us, but it is very, very scary news for us as a population. This was the definition of reserve banking. What had happened with the Silicon Valley, for those that don't know or didn't really dive into it. When banks take your money, Bank of Joe, Marlene gives me $1. I use that $1 to lend $1 to Jacqueline, Catherine, and Monique. So I have the $1 and I have the $1 on the books, but I have lent out $3. This is normally not a problem because you don't normally have runs on banks. And you don't normally have the type of mortgage-backed security issues and treasury bond issues that we have going on. What happened with Silicon Valley was they became over-leveraged, and they were playing in the real estate game of these lower interest loans. They were taking lower interest loans and subprime loans, trying to drum up business, trying to drum up capital, and then they got called. Meaning that investors started to do a sell-off, somebody got nervy, and they did not have the money, the liquidity in the bank to provide to their clients. This is horrifying. This is, in some way, shape, or form, what happened during the Great Depression on the runs when the population, 24% of the population were destitute. They did a run on the banks didn't have money. It got even worse for a little bit, as once somebody peeked through the door, other people are going to start taking a look at what's inside, right? And what they found was our banking system, the world's banking system in the reserve banking markets, meaning Swiss and French and German, the ones that were not backed on gold, they all started showing liquidity problems. For example, big name that would affect us, Chase Bank. So Chase Bank came out with their own reporting, and they said that they had in the neighborhood of $1.7 trillion in holdings, and they had $25 billion in liquidity. That is a huge, huge unacceptable gap, especially during wartime and especially during the times where we have major powers that are heavily invested in America. For example, if China wanted to call Chase Bank, they could collapse Chase Bank. And that's how scary it is. So doom and gloom, all doom and gloom aside, come back to how it affected us. Well, the Fed, up until that point, was hammering us with increases, right? We had said that, we had been talking about the Fed was hitting us with 0.5% rate, and then they went down to 1/4. But the Fed was still not happy with where the inflation mark was, the numbers they were seeing. With the banks started to collapse, that was the breaking point, or is a major breaking point amongst some other data points. But they can no longer, they really now had to make a decision. Do they continue to fight inflation as harshly as they are, putting the banks, the American banking system, tremendously at risk? Or do they stop the hikes or even reverse? So we, again, bad news is good news. The Fed, literally 3 days before Silicon Valley came out, said, we're still going to continue to manage the inflation problem. After the Silicon Valley problem or issue came out, the Fed backtracked. And for a while there, it was almost guaranteed there was going to be a 0% increase. Then a couple of other banks came out, as you may have heard, all local banks. Symmetry Bank was one. There was another bank that was heavily invested in crypto. That was another that started to collapse. And then Charles Schwab started having problems. Major investment firms started having problems. Well, the banking industry did what it had to do, which you would probably never see again. And they decided that to save their own butts and to save the industry, they were going to have to not earn. And 137 banks came to the rescue of Charles Schwab. Charles Schwab. Yeah. What that meant was the banks were correcting themselves, and the economy was utilizing what was already out there to try to create some consistency. That was the start of May 9th to now. That was a start of over, at the peak, it was over 200 basis point gain in rate, meaning positive for us. So at the end of all this turmoil, the last 3 months, where in November we were quoting close to the 8s, 7.5 and 8s for normal paper. I'm talking normal credit, normal debt to income, those type of things. We were getting close to the 8s. FHA programs right now, I'm quoting about 5.25 with a moderate points. So we are where we are below the rates now, and have been consistently for 30 days below the rates that we were pre-COVID, building up to COVID. So it's a fantastic time for us. The volatility is still tremendous. News breaks and the bond market reacts. So where I'm looking for long-term and I'm looking for consistency, I think the long-term game is we've moved I think we've broken through the bond mark. I think that we are on our own leveling process. And I think that we are going to be able to see probably closer to end of quarter 3, mid fours, mid to high fours, with an average point buy down. What I mean by that, right now, average point buy downs are almost two points. So what that means for you all, ladies, tremendous opportunity. When the rates are low, that means your equity, that means your purchasing dollar goes a lot farther with different condos, townhouses, and everything like that. It gives first-time home buyers, and it gives folks that middle-class folks that are looking in that middle class range the opportunity to come in and not have to pay $4,000 for a $500,000 home. Maybe they're paying low 3,000s. So it's a tremendous plus for us. This is really where we wanted to be. This is really what we wanted to see. On to programs. So I was hoping to come and talk to you all about this fantastic new government program. The CalHAPA programs, as we were speaking to late last year, programs that was so unique was the forgivable program, where the Fed was giving a 10% forgivable from their down payment. They had since stopped that, and called Dream for All. This was an amazing program that had the government assisting with 20% down for new home buyers in the same income bracket that the other CalHAPAs were in. The interest rates were not particularly high. In fact, they were mid sixes, high sixes for these programs. And the 20% down, ladies, you didn't have to pay back. This means your clients walked in without having to pay mortgage insurance. They walked in with their percent of equity. There was a number of benefits. You heard me right. Jennifer, March 17th is when this program came out. Thursday, so what? April 6th, right? Yeah. April 6th, they called pause to the program. $700 million allocated for this CalHAPA program was done in 2 weeks. The other part of the program was, as you may know, with the FHA first-time homebuyers, they have to take the first-time homebuyer class. The homebuyer class site crashed and had filled up so fast that first-time homebuyers weren't able to get an appointment prior to May 16th, which is a lot farther than 30-day escrow to complete the course they needed for this program. So it was a tremendously successful program. I don't know if it was managed properly. They said they were going to be doing the program in $50 million increments. They've had to do $50 million a day increments every day for that to be true, but we'll see if that comes back. There's no more money. CalHAPA does run out of money. Normally it's towards the end of the year. But like the USDA programs, what they got is what they got, and the utilization is the utilization. So what are we doing to balance this out, and what are we doing for CalHAPA, for first-time homebuyers? So CalHAPA, like I said, is still doing their 2% and 3% ZIP programs. None of the programs currently are forgivable. However, the 2 and 3, meaning the closing costs assistance and the down payment assistance, those are still silent seconds. So those are still loans that will sit and not continue or not need payment. They will need to be paid off. They are still very helpful in some cases with clients. There is Fannie and Freddie have first-time home buyers now, where if you're normally expecting to use a non-FHA product, you're thinking 5% down. Fannie and Freddie have a 3% down program. FHA, of course, is 3.5%. So there are still other programs out there. The one program that I wanted to highlight that is really starting to become a tremendous program for our investment clients is called a DSCR. A DSCR program is one of the programs that investors can use to purchase, refinance, or to purchase or refinance their investment home. And here's the kick. There is no documents needed. We do a credit pull, and there is some reserve information that 3 months, 6 months, or 12 months, depending on their credit. But as long as you have a property that is able to be rented out at the same amount or more of what your payment is, what your PITIA, then they will give you that loan. There is no income necessary, other income necessary. There is no, as far as normal full doc purchases and refis, there's none of that. It's straight up what the appraisal comes in at, as far as what the property is able to be rented at, and what your payment is. This allows your clients to really access a lot of funds in a refinance sense, to access the funds without having to think about selling their investment. This also allows your clients, especially your clients, let me say this right, I was going to say younger clients, that's not true, entrepreneurial clients, that if they're sitting on some equity in their home and they say they have $100,000 in their home, they want to access that 100,000, but they want their money to work for them. They're smart investors. They're not looking to fix and flip and risk. They want a sure thing. As long as they have 30% down on these first-time home buyers, they can literally pull out whatever that 30% is, normally 100,000, right, for a $300,000 house, pull out that of their home, and then immediately getting into an operating, working, and profitable rental home without docs. They don't even need to have a job, because the rental itself is acting as the collateral. So it's a fantastic, I mean, it really is a way that you can help your clients build wealth. If you start talking with peers, or your clients say, I wish I can get into a rental, I wish I could do this. Let's talk. Let me explain the program to you. Let me explain the program to them. It really is, as far as qualification, it really is that easy. Don't have a couple of questions that come up with, can they use Airbnb rental income? Absolutely. Where normally most of you are thinking, the ratios are 75% occupancy. Airbnb rental can be up to 60% occupancy, and they don't use a 75% occupancy for standard rental contracts. The other question is, do I need a rental contract? No, you don't. You don't need to have an established renter or a rental contract to get into this loan. You have to just have the appraisal. Everything depends on the appraisal and the appraiser coming back and seeing what the community amount for that rental will be. So this is, this is just one program that you can share with the friends and clients that you have that are really looking to get a footprint in real estate ownership. Very interesting program. This is a non-QM program, so there are 3 different investors that actually hold these loans. That's how they're able to do it, is they are the servicer on these loans.
FICO are they looking at?
I'm sorry?
What kind of FICO are they looking at to get into that program?
So let me pull up my matrix. Amazingly, what you would think would put them behind, and I'll send you this information, Monique, and everybody. We can go with the group that I like to use we could go as far down as 680. When you get the lower FICOs, you start to have a little bit more overlays, meaning they may need some stronger reserves, or they may have borrowing limits. 680 cannot borrow 70%. They can only borrow up to 65%. So there is some give and there is some take on the FICO score. There is a prepayment penalty on these. It is built into the loan. The prepayment penalty built in is normally 3 years, and at that point, the pre-penalty itself is 6 months. With a 3-year build-in, it's 6 months of the projected interest is the penalty. So it's not a crazy big balloon at the end. The 680 is just for this one lender. Monique, I do have this program that'll go down to 660.
Dang, that's pretty good.
Yeah.
For your players that you're working with that have the money, the 30% down, 30%, really this could change some people's lives. If you had a client that was sitting in a position with a couple hundred in equity, as we do because of the home values climb so high, if you could say to them, we can get, you want to tap into some of that equity and you want to start your own rental, and that's a long-term, it'll be a long-term run, but being able to get into a rental without having to use your own income and to support both your house and the new rental house, and having to have other people on the loan for income, then comes their debt. This is a tremendous way for your clients to start building wealth if they have that initial down. Just one of the
investor groups, or is it just strictly more for this is my first rental type program?
Yeah, great question. There is actually first-time renter program in this. Most folks that take advantage of this are working with groups like ours that have a variety of programs and have a clientele book that are renters. So if you are a rental, if you happen to be a person that has 3 or 4 rentals, yes, this program's open to you. It's available for single family residents, PUDs, townhomes, 2 to 4 unit, condos. Cash outs can be up to $500,000. Here's the other thing, and Marlene, this may surprise you as well as everybody else. When I'm speaking of reserves, what the reserves are is if I need 6 months reserves, that means I need 6 months in your bank account of what the payment's going to be. So if your payment's $1,000, I need $6,000 in the bank. That's 6 months reserve. If you're doing a cash out and
that need to be seasoned.
No, check this out. If you're doing a cash out and you want to take out $100,000, you can use the cash out amount as the reserve. So you can use the home's own equity as your reserves in the bank.
That's crazy.
Yeah.
It's crazy. Now,
can they use their HELOC to be the reserves?
Has to. Yes. Actually, if there is room. So obviously, it can't be maxed out, right? There would have to be 6 or, in this example, 6,000 in the HELOC. Yes, that's a adequate source. The next question would be, what are we looking at with rates and programs like that? These are actually still in the 7s. These are not crazy rates. Our investment properties are already in the high 6s. And so for incremental growth on that rate for what the program is, that's pretty outstanding. There's also, if you are talking with a pure gambler, there's also adjustable rate options or 10-year interest only options for these programs. So completely flexible. You can really design this around what your client needs if they're if they're in that position. And Monique, this program is available in Tennessee. By the by, my license is back in Tennessee. So none of these are just California specific. The Cal HAPA is obviously California specific.
Yeah.
There is other.
That's awesome.
Yeah. There's other state stuff. So yeah, so that was I know that was a lot of information. There's been a lot going on with the mortgage industry in the background these last 3 months, but at the end of the day, we're looking at fantastic rates, the best rates that we've been playing with in a very long time. You're looking at programs that are being utilized for $700 million. If you think about that program, think about it just a little bit. They were offering 20%, the average home price in California. If you did 20% by that average home price, say 400, that should have been a lot of loans. That should have been a lot of loans. 700 million, only doing 20% down on home prices. For that to have been completed in 2 weeks, it tells you what the desire of the clientele out there is. Maybe the market is not showing a huge gain or dip. You know, there may be other indicators. This is just a raw data indicator of what's actually happening. What's actually happening is people want to buy, and people are buying. It's great news for us. Not that the program's gone, but it's great news for us.
Cool.
Last time we talked, the 2-1
I definitely want to
buy
get that stuff.
Yeah, I'll send this all to you. The 2-1 buy downs that we were talking about early in the year, those are still available. 3-2-1 buy downs, those are still available. The jury's kind of out on whether that's a product, especially in this market, we want to put our clients in. The short-term adjustable rates. I'm not a big fan of adjustable rates in the volatile market right now, but main reason is they have to qualify. Say these 2-1 buy downs, your qualifying rate is a 7, and we get them into a home at a 5. The concern is people get used to the money they get used to, right? And so for a full year, they're playing and spending like their home is at a 5%, and then the year comes up and now the rate's at a 6%. That's a tremendous increase. 1% is tremendous, hundreds of dollars. And then year 2, now it's at a 7%. Now we're incrementally even more hundreds of dollars. Really, our first test of this program is coming up shortly. The program came out last year in May or June, I think. So the 1-year mark's coming up. And like I said, this is going to be a big test on the market. It's going to be a big test on the economy and on the appropriateness, I should say, of this program to see. Foreclosure rates are already going up. We're gonna I will be reporting and watching those numbers very closely. I was hesitant putting folks into it. Everybody wanted that lowest rate. We'll see. The good news is there is still a ton of equity in the homes and the rates are lower. And so people that are having to refi because of high credit debt or other reason, they're actually not getting hurt as bad as they would have last year. I'm doing a lot of cash outs right now, a lot of debt consolidation right now. And I'm doing cash outs in the high 5s and low 6s. So it's actually, I think we're going to see ourselves through this. And I think home prices, Marlene, you could speak to this too. Home prices dipped, but we were for about a half a minute into a buyer's market, and then home prices dipped, about 7-8%, and all of a sudden sellers started getting the advantage again. So we really never saw a pure buying market that we thought we were going to transition to, right? It's always yin yang, yin yang. They kind of went like that. So a real interesting time right now. A lot of stuff going on. Everybody knows the war, the inflation, the election coming up next, all the Trump business, and everything is affecting the market. Everything, banks clearing themselves up, us continuing to print money and continuing to print money. We still haven't gotten an answer on the student loan forgiveness program. Keep that in mind. And a lot of people were counting on that. Seeing a lot of defaults because the payment protection programs on the student loans are going away. And I'm seeing a lot of negative debt, or excuse me, well, yeah, a lot of negative debt, but a lot of negative impact on credit because of these programs. So at the end of the day, great time to buy. You never let a good crisis go to waste. So I mean, if as we're going through this, those that can will be very successful. I would suggest all of your client activity is going to, especially now that we're in Q2, is really going to start picking up.
Mm-hmm. I see this market as, some people would call it crazy because of all the things that are going on. But as Joe just shared with us, there are so many different programs. I'm blown away by the DSCR program. Is that what you call it, the DSCR?
Yeah, it's called DSCR, and I had it up. Hold on, DSCR. There it is. It's the name, debt service coverage ratio. I always forget the technical name. Yeah, it's literally using you be back? Literally using its own operating business to fund itself. Just a great opportunity.
I can see that being a way to niche yourself into working with investors. There was a time in real estate when I concentrated on working with investors, and what I like about niching, and you guys, you hear me say niching all the time, that's because when you niche, you become known as the agent who does whatever it is they're doing. It could be first-time buyers. It could be, for me, at a time, it was investors. And what I liked about that is, as I'm working with investors, I go to their little meetings, I hang out where they hang out, and you become the agent who works with investors. Your phone starts ringing. So anybody who's interested in niching and working with investors, I would definitely talk to Joe about this program, because this is better than anything I've ever seen. And some of these other loan programs, gosh, Joe, there's something for everybody. So what, could you back up a tiny bit? And I know what a 3-2-1 buy down is, but I'm not sure everybody understands that concept. So if I'm a realtor and I have a buyer, what would I say to them to, not that I'm trying to encourage them to do a 3-2-1, but if I see their situation, would I just have them talk to you and you figure that out? Or is there something I can say to them before they talk to you about a 3-2-1?
Sure. 3-2-1 and 2-1 are basically very similar programs. These are seller concession paid programs. So it's not out of buyer pocket. And what it is if we purchase, say you purchase your home today and your qualifying rate is 7, the seller basically funds the difference between the payment, let me back up. So if you purchase the home and your rate is 7, the 2-1 buy down, 3-2-1 buy down means that for your first year, the 3-2-1 for your first year, your client would be paying their home mortgage rate at a 4%. Then the following year, 5, 6, 7. Yeah, 3-2-1. So 4%, then 5, then the following year 6, and then the final year would be 7. And the way they're able to do that is the seller the concession is basically the difference between what the payment of the 7% would be versus the 4, 5, and 6%. So they cover that whole thing. The client does not have to do anything. There is no qualifications for this program other than normal Freddie and Fannie, and it's a Freddie and Fannie. This is a QM product, so it's a normal Freddie and Fannie product. Really would just be up to the realtors to negotiate that concession size. The dollar amount or what you would have to negotiate for, that would be given through me, and we would just simple calculation would give you the number and say, hey, Catherine, you need to talk for a concession of 20,000 or more, and we'll go on it that way. The selling points that you could use for your clients were it allows them to save that money, incremental money, for 2 or 3 years that they would normally have to do on the payment. There's no repayment penalty or repayment payback or anything, because the seller concession already covered it. In fact, if your clients ask, well, if I did this 2-1 buy down, but we say something happened and we sold or refinanced in a year, what happens to that money? Is we still had a year's worth of money? That's their money. That actually gets added on to either their payoff or their down payment for their next purchase. So that is actual money. That doesn't disappear. That's what I mean by this. There's no qualifications for this program. Think of it as an escrow account. That difference sits in account ready to pay for you, and it's there and it's yours if you call the loan before the end of that account. My only concern, and really kind of talking behind the door as a lender, my only concern that I would have is that program needs to be used responsibly. If you have a client, and I would be able to assist you with this as well, being able to look into their financials. But if you have a client that is a spender or shows signs of not necessarily a lack or negative responsibility, but shows financial signs that they like to spend, I would be concerned, and I would voice my concern for the benefit of the client. Because like I said, if you start getting used to for a year, and your household budget for a year is based on $1,000 home payment, and then that next year comes up and now it's time for the rate to go up that 1%. Now your mortgage is $1,350. That's a lot to absorb. Yes, you qualified on the higher rate. Yes, according to your finances and according to the loan, you were able to do it. But a year is a lot of time, and the increase is a lot of time. 1% increase is a lot of increase. And so Americans, as you know, none of us plan. If you plan, consider yourself a 1%er. And none of us really plan. In fact, there was a study that just came out this week that said an overwhelming majority of Americans could not come up with $2,000 or more in an emergency situation today. And so that relates to the 2-1 and 3-1 buy down. If I take a look at a credit and they've got 7 open trade lines, 10 open trade lines, and they're all over 30%, and they've got a Nordstrom and they got a Target and a TJ Maxx, they got all of the shopping carts. I would be worried about putting that client into a possible default situation. So it's a good program and solid program, and it does save people money. It just really is a type of counseling, almost a friendship talk of, hey, with great power comes great responsibility, right? With this program comes responsibility, and knowing your home payment's going to be going up unless you refinance into a lower rate. Again, and I'll kind of end with this. As a lender, that's the way the program had kind of been designed and had kind of been taught, and is a Band-Aid for the rates, and not necessarily a successful long-term program. And you can see this because companies like Guild and Wells Fargo got out of the game, but Guild and Rocket and a lot of major players and a lot of major online players, when this program came out, you remember the ads right along with it said a free refinance within a year. because they were using the 2-1 and 3-1 buy down as a band-aid and as a teaser, knowing or hedging that in a year the rates were going to go down, we could refi them and get them into a fixed rate that's not as not necessarily dangerous, but susceptible to default. So I think it's a good program, used responsibly. And I think it's our jobs, especially for clients that we're looking to have year over year and family and friends and referrals. It's our jobs to kind of be those baby counselors and saying, I mean, and you've all been in that position, right? Yes, everybody loves this house. Can you afford this house? Sure, you can afford the payment. Can you afford the electric on a 5,000 square foot house, the AC on a 5,000, you know, there's realities, right? And y'all been put in that counseling situation where you've had to talk maybe, you know, some big eyes on a beautiful home down to more realistic, successful ways for them to be able to live long term.
Thank you, Joe. That everything you shared, these are things that, like I said in the beginning, we as realtors, we're not necessarily held to know everything there is to know about the loan world. And that's why we have a partner strategically in place that we can go to and get all that information fine-tuned into the client. And I have to tell you, I'm very grateful that Joe works with us. The compliments that I get from his responsiveness, it makes us look better. So I just want to encourage you to, as you're thinking about your marketing strategy, think about how you want to work with buyers. Now, Joe talked a little bit about, you know, we thought we were going into a buyer's market. I thought so too. In fact, I was talking to people excitedly about, hey, we're getting into that buyer's market, and now we're not in that buyer's market anymore. So the strategy typically is you want to try to get listings, but the inventory is so low. I mean, Jacqueline has a listing coming up, and I'm like, oh, kudos to you. You got one. But it's going to be hard right now to be that one agent out of hundreds of thousands of agents in this area to get the listing. So I'm not saying don't niche and don't try to get listings. If you do want to strategize and work only with listings, what I encourage you to do is really work that and really fine tune your marketing efforts so that when people are thinking about selling their homes, they think of you, that you're that person that they're going to call to list their home. And you really do have to stand out among all the other realtors in this market because the inventory is so low, because so few people are thinking of listing their homes. So for me, if I were thinking about who I wanted to work with, I would now be trying to work with buyers and being that agent who, when they're thinking about buying a home, they're going to call me, because there are so many different programs. A lot is happening. There's so many different programs available for buyers. So just kind of be thinking a little bit about what you're going to be doing moving into this market. Like I said, it kind of changed on us, and we were all excited about doing just being in, getting all those listings, but that didn't happen. So it's kind of time right now to just re-strategize. Know that even if you're going to fine tune and go with listings, you're going to be okay. You're going to be successful, but you will have to work extra hard to get those listings. But working with buyers, it's not going to be easy either, but whatever you do, you want to be that person. It's hard to be recognized as someone who does both in this market.
I don't know if anybody, Marlene, if you have any of your group focusing or learning or studying about the short sale market.
Mhm.
Oh, I like short sales.
Is that you, Catherine?
I know she
So,
does.
I would very much so, Catherine, encourage you to continue learning and educating yourself about the process, short sale. So I'm a pro guy, and I'm happy when my friends are happy and then successful, and I never hope for negative. But I'm also a Capricorn and a realist, and the short sale opportunity I think is going to be similar to 2009, 2010, and 2011 right now. I have a couple of partners that are making the shift and are throwing a bunch of eggs into the short sale basket, learning the program, the ins and outs of the program. Marlene, you're talking about a niche. I will tell you personal experience. I short sold a house in 2010. I short sold a house, and I had to find a short sale realtor. I had to look at actively research and find, and she did a great job. She negotiated very well for me. But with that being said, complete niche product. I'm not sure what y'all, I don't know if that's a regulated, short sale is a regulated industry or not. I'm not sure how much you're able to actually charge on your rates in the back end, but I know it's profitable, because at the end of the day, when the governments agree to these loans, they don't agree to lose money. They're still making their money. But nonetheless, I would encourage you all to get some active knowledge on that short sale range. You could very much find yourself in a 3 or 4 month period where that is the hot market and people are looking for short sale purchases, and maybe your clients, God forbid, are looking for help short selling. And so I agree. I think one of the more successful bets you can take is becoming very familiar and taking some of your time to learn those programs. I'm definitely, I am doing so on my end, because there's a lot that goes into it. We have to get the banks to agree. We have to get the investors to agree. We have to get sign-offs. We have to show it's a deep dive into their finances. Heck, sometimes you even need letters, from other people saying that, they're being honest. So, I mean, there is a lot of different to it, but yeah, I agree. I think that would be a great opportunity for y'all to get some experience on that or knowledge on it. As I start gathering stuff, I'll start sending it out. It hasn't really happened yet. It's going to, I guarantee it.
Oh, yeah, I believe that. And I mean, I see it. And Joe, thank you for sharing that opportunity, or that your insight into that niche. I actually have my short sale designation. So that's something we could all work toward and become that person, like I said before, become that person that people go to when they're thinking of short sale. And there is a lot to know about short sales. There's a process. And we're working with lenders, and we're working with all kinds of people when we're doing short sales, but it is actually kind of a fun niche. And once you get into it, you know the ins and outs. And a lot of realtors don't tackle the short sale industry because it's not easy, but it's something that can be extremely lucrative for the agent who knows how to do it and become that agent that everybody goes to. Even lenders will, go to attorneys. People will start seeking you out, and the phone rings versus you having to get on the phone and call people. And there's a strategy approach to working short sales. So thank you, Joe, for sharing that, because niching is going to make a difference in your lives. And when you're niching in an industry or a segment of real estate that's booming, you're going to be successful. You can only not be successful if you're just not working. So
I think, and Jacqueline, correct me if I'm wrong, but you are working and prefer to work into the luxury market, right? The higher end market, is that correct?
Let's see, what time is it? Jacqueline might have had to step
Sorry,
out.
yes. I was trying to find the mute button.
Oh,
So are you aware of the mansion tax that just hit?
No.
That's crazy what just happened. That's off the hook, man.
Yeah.
I would have jumped out too.
So since we're talking, and Marlene, please shut me down if I'm taking too much time, but specifically, Jacqueline, I was thinking of you when I heard about this information. The California mansion tax just hit. No, Monique, what was that? 2 weeks ago, I think.
It was like the end of March. It was
Yeah.
like right before the end of like the last week, third week of March or something like that.
Yeah, it's a 2%. I believe it's a 2% tax on $5 million or more sales across the board. That
I thought it was up to 6%, up past 5.
is it?
Oh,
Was
God.
it that much?
It's layered. It's
Yeah.
like if it's under, I think it's 5 million, then it's like a 2.3 or some crazy amount, and then it's like if it's over 5, there's a higher percentage or something like that, or maybe I'm mixing it up. But I just do know that a lot of celebrities down south were jumping out of their homes, and even if they were taking a cut on the pricing of their mansion, they were still going to save money versus paying the tax, because this tax is required to be paid whether they make a profit or not on the home.
Right.
Wow.
Exactly. But it is also write-off. It is also a write-off. And so,
right off.
so Jacqueline, I know there was a mass sale last month. As Monique was saying, a lot of the higher end folks trying to get out of California. You know, one other thing pushing us and pushing our dollars and pushing our, I can go on forever, out of California.
Tennessee,
right?
that's what they're doing with their money.
I'll tell you what, I've got 3 loans out of Tennessee right now, Monique. That's no joke.
It. South Nashville, you guys, South Nashville, if you're sending them, if they got money, send them to Brentwood. Send them, they're coming down. I know it's kind of ironic. Both Brentwoods are flourishing, but Brentwood, send them here.
No. Jacqueline, what I would approach the mansion tax, if you're getting questions on it, I would approach it by just kind of briefly hammering it. Yes, it's a required tax brought on by Newsom, California administration, tax administration, wealth tax. I would kind of play with it. It's just one of those, play around and say, this is one of those things where California's trying to keep their hand in your pocket. But I would hammer, it does go on as a loss. You can claim it onto your taxes. There's a number of other creative stuff that you can do with it. I do have a couple of, and I would suggest y'all have a pocket one too, a couple of financial planners or tax advisors that you can have your clients. And Jacqueline, this is very as important for you in the high-end market as for our clients in the $250,000 and $300,000 market, of being able to provide an outlet for them to ask questions if they're so inclined. This could make or break a deal. Having somebody being able to talk to them and answer 5 minutes worth of questions on it. Is this right? Is this a smart move? Will I be hurt or will this help me? I've helped purchase several homes where people have referred to their tax advisor before moving forward. So
I did want to interject. I do believe, and I'm actually looking up, I think it is only for the LA market, not for California across the board.
Oh, but it's moving. It's moving. So that's a test. And your next market, they're looking at San Francisco, and then it's a test run.
And they're saying it's a 4% tax on sales over 5 million and 5.5 on those above 10 million.
Okay. Okay. One last thing. Sorry, Marlene, I promise this is the end.
it's all good.
Speaking of tax, the FHA upfront mortgage insurance premium and the VA funding fees, those both decreased this year. So the FHA upfront funding fee, as you know, there is a fee to get into the FHA programs, and that fee was 0.85% of your loan amount. That has been reduced to 0.55. That's thousands and thousands of dollars. The VA fee, those have gone down. It was 3.2 and 2.6 consecutively. There's tiers on how they can use it. And I believe it's 2, 3, and 1, 1. I don't know the exact on the VA, but those fees have reduced as well for the VA if they're less than 10% disabled on their discharge or current active duty. So those are great. Those are another great benefits, helping generational wealth, especially the FHA programs. And those are stuff that I can explain in full to your clients once we get to that point. That's it. I promise.
Yeah, awesome. But
Real quick, Joe, have you heard anything on USDA loans? Anything new in that market?
Nothing that stands out. There was some updates. I'll find out. I'll look into it. There was nothing. I don't think there's any major changes to it. I think there was some income changes. There was some income updates. I do know the program is still active. I thought there may have been, besides the income, I thought there may have been structural changes or demands on the property, but nothing that stands out that I remember as being noteworthy.
Okay, cool. Thank you.
Great. Thank you, Joe. Thank you, everybody, for being here. I do want to pay attention to the fact that it's your Saturday, and I'm so happy that you joined us today. We got a lot of good information, solid information. And for those of you who are thinking about postcards and letters that you could be sending out, a lot of the information Joe shared today can be used to put on a postcard or in a letter. I mean, just knowledgeable information, things you can say something like, guess what, the FHA upfront funding, the costs have been reduced. You can talk to that. So I'm glad I recorded today's session, because now you can go back and kind of listen to all that Joe shared about the different loan programs. And when you're thinking about flyers and letters flyers, letters, postcards, any kind of communication that you want to send to your clients, your Facebook page, you could post a little something about anything that Joe has talked about today. And it doesn't have to be long and drawn out. It can just be as simple as VA fees have been reduced. Call me for more information. And then, of course, you're going to point everybody to Joe, because he's our loan guy. So I just want to thank you again. Does anyone have any last second questions before we end? You all good? Okay.
I'll be sending out the DSCR info via email to y'all right now. And then feel free to follow up with any questions, or if you have clients, feel free to give me a call on the cell phone. If you're even in front of a client real quick and wanted a quick explanation to them, don't worry, don't hesitate, give me a call, and I'll speak with them.
Yes, and Joe has proven that to be true. Thank you, Joe. So everybody, I want you to go out and have a great real estate day, or just enjoy the day if this is your day of relaxation. And remember, today's session is recorded. I'll have that put up on the agent portal, a link so that you can rewatch it. Okay?
Great. Thank you.
So that,
Thank
all right.
you.
Have a wonderful day.
Thanks.
y'all.
Have a great day.
Good seeing everybody.
Good to see you too.